Hi, you're watching ET Markets Live. Welcome to a brand new episode of ET Smart Investor, where we discuss all about your investments and much more. I'm Neha Vashish Mahajan. Today, we are going to decode everything that's happening in the world and how you can navigate through it. Joining us today is Chirag Muni, Executive Director at Anand Rathi Wealth Limited. Thank you so much, Chirag, for taking out time and joining us today on ET Markets Live.
Thank you, Neha.
So let's quickly start with our session for today. Since we're going to talk about whatever is happening in the world globally and domestically also, let's start with the elephant in the room. Let's talk about Iran-Israel conflict. A lot of things are going on right now. The conflict has heightened in the past few weeks as well. Now, this has impacted crude oil, global markets, and political ties as well. What is your view on this, and how has this impacted the Indian market?
Yes, Neha, of course, it's been a very eventful last 12 days that we have seen. There has been a series of things that have happened. Initially, of course, like we know that it started with Israel attacking Iran on various of their nuclear facilities and their military bases, and of course, killing some of their scientists and major commanders as well. And then we saw that initially US was not involved, and Iran retaliated with their drones and ballistic missiles, and in fact killing civilians and damaging the infrastructure. Then we saw that on 22nd, of course, there were bunker busting by US getting involved and damaging their nuclear infrastructure. And we saw last 24 hours, we've seen that some kind of ceasefire has also been come to. But the situation definitely remains still fragile because there have been reports of obviously violations of ceasefire as well initially. And currently, of course, situation looks like it's under control, but there has been a lot of heightened volatility in these 12 months. But as far as impact on the markets is concerned, specifically on the Indian markets, we've seen that we've been quite resilient. In fact, last 12 days, the Nifty has moved up 1.5%, about 1.4%. Crude oil, of course, there was a lot of volatility in the oil because obviously, Iran controls some bit of oil production, so there has been impact on the on the oil. But again, it's normalized back to where it was, about 66.5 dollars, and that's where we are currently.
Can we also talk about the role of Iran in the global oil production and how it holds power when it comes to different routes? Which country or countries do you think are said to be affected the most if anything goes wrong?
So, in the context of the overall, oil production today, Iran, produces about 3.5% of the overall supply, and whereas and its significance has actually gone down over a period. In 1970s, it used to have almost 10% of the overall oil production. When moved down to about 5% in 2000s, and now it's about 3.5%. In fact, the major oil producing countries today are US, which is 22% of the overall oil production, and then Saudi Arabia and Russia, which is 11% odd. In fact, China, Iraq, Brazil, some of these countries, and Canada, basically produce more oil than Iran today itself. So overall, direct impact on the oil production is very less, to be honest, because it's just 3.5% overall. But they indirectly, of course, can disrupt the overall supply because they have direct control of the Strait of Hormuz, which is where the overall specifically all the oil that moves through Asia moves through that route. And that, if they have control over that and they close down that, of course there can be impact on the overall global oil prices. They also have indirect control over the Red Sea through their Yemen rebels, which is the Houthis. So that, of course, can definitely have an impact on the global oil prices. And we've seen in the past that some of these instances has led the oil to move almost 25% up. But it also normalizes again. But the idea is that there will be volatility in the overall oil if they actually kind of do something on those routes.
Okay. Can we, as you mentioned, that it has happened in the past as well, uh, do we have any examples to understand the after effects more?
Right. So we have couple of three large instances that we've seen where the global oil production, I mean the global oil prices have moved significantly up. So if you look at in December 2011, there were sanctions on Iran, and they threatened to kind of close the Strait of Hormuz. And that's where we saw almost a 25% jump on the crude oil. And by the time the oil prices normalized was almost 4 months. But if you look at again from a market perspective, especially India, during the same period, actually Nifty moved about 4.5%. And if I take a 12-month period from the start when that happened, it almost moved 26%. So the impact on India was quite less, like I said. Then, of course, we also saw in 2019 there were some Gulf tanker attacks, and that's where again oil moved about 10% up. Again, it took about a month for oil prices to kind of normalize. So that month, of course, the Nifty moved down about 7.5%. But eventually, in 6 months, again, Nifty was kind of flat. Market was quite resilient at that time. And lately, we saw in November 23 again there were some attacks in the Red Sea, and resulting in a lot of rerouting of tankers. That's where again 15% movement on the oil we had seen on the oil prices, and that took about 2 months to normalize. But again, Nifty had was almost about 11% during the same period. So the impact, while it looks the sentiment is quite negative, but the impact on the markets is not too much. Because technically, like I said, the overall oil production is about 3.5%. That they have a temporarily, they can, of course, you disrupt the oil supply because of the routes. But other than that, there's not a major impact that we've seen.
Okay, but uh, not just talking about Iran, but the entire situation with Israel also, and the involvement of the US. What could be the impact of all this on India and Indian markets?
But the impact on India is quite limited, and we've seen that, of
Hmm.
course, the evidence of that we've seen in the last 12 months. And the reason for that is that we have stopped producing, in fact, importing oil from Iran completely since 2020. Our oil imports are, specifically they've risen from Russia, like we have seen after COVID. And 35-40% of overall oil comes from Russia. So that doesn't, so these routes don't impact us so much. Of course, like I said, there can be impact on the overall, oil prices. And if the highest that we have seen last in such kind of instances has been a 25% jump. So if I have to put some math around it, and the oil actually moves from 65 to $81, which is a 25% jump, which is the worst case scenario that we have seen in the past. That could have a $15 billion impact on our deficits, and that effectively is nothing but 0.3% of our overall GDP. So the GDP could slow down a bit in about 0.2, 0.3%. Nominal GDP will go up, real GDP might go down because inflation will go up because of the oil prices, and 30% of our overall imports is just oil. So the inflation can go up about 0.7%. So the nominal GDP can go up about 0.5%. But net, the impact is not too much. Some sectors might get impacted, whether if the airline sector, of course, because of the oil. But the oil, on the other hand, some of the oil companies might benefit, especially the oil extraction company. So net, the overall profitability will not get impacted. Short term sentiment driven, you will see volatility in the markets, and nobody can take away from that. But I don't think so. It can really impact the overall trajectory the way we are going.
Okay. Let's also talk about Indian markets from strength perspective. Do you think Indian markets are strong enough to power through this situation that we're facing in 2025? Because earlier we had tensions between India and Pakistan also, that now it's Iran, Israel, and then something is going on with Russia, Ukraine also. Some kind of war is always happening. So what do you think about the Indian markets and its strength?
So, like I said, Neha, the short-term volatility cannot be ruled out because ultimately markets are sentiment-driven in the short term, but in the long term they are more macro-driven. How's the shape of the economy doing, and that's where I think India scores significantly higher. We saw last year 6.5% was the GDP number final, and then we are expecting about 6.6. So India remains the fastest growing major economy. So from a GDP perspective, we don't see so much of derailment. Like I said, even if there is some kind of disruption of the oil prices, so we continue to remain the fastest. If you look at inflation, we are in May we were at the lowest of about 2.82% compared to 3.16% in April, and that's where the RBI is also so comfortable, and they've cut almost 100 basis points this year. That again, gets a lot of operational leverage for the corporates, and of course, a lot of boost in terms of consumption that can happen. If you look at fiscal data, also we are completely in control. We have revised our fiscal numbers to 4.8%. In fact, a 2.7 lakh crore, which is given by the RBI to the government, again, helps us shaping our balance sheet so well. If you look at tax collections, May was some of the highest, about 2 lakh crore that we kind of collected in GST, almost a 16.5% growth from last year. Even the first 2 months show the direct tax collections have gone up about 14.5%. So if I look at any macro number, whether it's the GDP, whether it's the inflation, whether it's fiscal deficit, whether it's tax collection, all of that really says that India is really moving fast in that perspective, and we don't see a major dent there. Of course, short-term dents can happen, but the expectation from the Nifty, I think, from a 1 year perspective, we think it will be in line with the nominal GDP, which will be about 11 to 13%. So that's where we are currently.
Additionally, what are the Indian market valuations are saying right now? What is the data saying? Can we shed some light on that also?
Yes, absolutely. The 1 year estimate on the Nifty is about 13%. In fact, on the mid cap, large cap also, we are expecting about 18 to 20%, because we don't see, we are fairly valued. In fact, we see some kind of a negative froth, specifically on the Nifty, and the other indices. Because if you look at currently, we're about 25,000 odd, and the 1 year long term average P's on the Nifty has been about 20 times. In fact, whenever bond yields are lower, you command a higher premium. But even if I take a base case scenario of about 20 and a half on the 1 year forward EPS, then we are talking about almost Nifty should be around 26,000 odd. So we are still about 4-5% negative froth as far as the large cap is concerned. Even on the mid cap, we are looking at about 4 to 5% negative froth. So we are, I think, comfortably placed, to be honest, today, and we are looking at about 11 to 12% return on the Nifty for the next 1 year for sure.
All right. So before we close, let's also talk about what should investors do at this point, considering the current domestic and global scenario. How to invest and where to invest.
So, looking at current situations, I feel that it's going to be quite a good opportunity if you really see dips because of the negative sentiments that are going around the globe. Because the trajectory of India remains very strong. So, any downfall should be looked as an opportunity. We need to maintain our asset allocation. Anywhere between 70 to 80% equity is still fine if you have a long-term view of about 4 to 5 years, and about 20-30% can be in debt. Don't stop your SIP worrying about all the news around it. Like I said, the impact, even if the worst case scenario, the GDP impact is about 0.2-0.3%. So it's not going to derail the returns that we're expecting from equity. So continue your SIPs. Of course, continue to monitor it and review it on a regular basis. Maintain a 50-55% large cap, and rest could be in mid cap and small cap, divided equally. Diversify across asset classes from that perspective. So 70-30 is what I mentioned. So I think continue your path of investing and saving.
All right. Any funds you would like to highlight that investors can look at?
So, in the multi-cap category, we would want to look at the Can Rebeco multi-cap fund, which is likely to do well. Flexi Cap, always have been talking about HDFC Flexi Cap. That's been a star performer. We can look at the large and mid-cap category, which is the SBI Large and Mid-Cap Fund. In the small cap category, we look at the Invesco Small Cap Fund, which has done reasonably well over a last 5 year period. And in the mid-cap category, we look at the Kotak Emerging Equity Fund. I think these are the 4 or 5 funds. You can bundle them out, which can give you this kind of diversification across large, mid, and small cap.
All right. Well, this marks the end of our segment for today. Thank you so much, Chirag, for joining us on ET Markets Live.
Thank you, Neha.
Thank you so much. Thank you, everyone, for joining us today.